Hello, everybody, and welcome to our Illusions of Investing web broadcast. I'm glad to have you with us today. We are going to start our webinar today with a little bit of a video, I think, that's going to give everyone some context on what happens when people are trying to build their finances, do a better job with their money, and really take better care of their future, but they're up against so much. People have no idea how much they're up against. This video is going to give us a little taste of that while we bring in some of our other attendees. All right, everybody. Well, welcome to the Illusions of Investing and Sound Financial Group's web-based learning. Tonight, we're in for a 1-hour focused learning session. And what I hope you all can notice and be present to as you watch that video is really what everybody's up against. Everybody's up against a tremendous amount of difficulty in trying to build wealth. It's not easy. There's eroding factors, and there's even our own personal consumption working against us building the amount of wealth necessary to live the life we want to live. You see, we all have choices in life. We have the choice to take a vacation or not take a vacation. But let's just take it as imagine it being a trip. If you're taking a trip somewhere, you buy a plane ticket in a few months, you plan for what you're going to do when you get there, you pack your bags, you prepare, and anytime up to that trip, even though you've had preparation, thought, told your friends that you're coming, you could cancel it. Little to no consequence. You lose some money on a flight. You can cancel it anytime. What none of us get the chance to cancel is the day when our cash flow will stop. Now, in our planning philosophy and our tools like the living balance sheet, Our tools allow us to look at all the ways cash flow may stop. But one day, hopefully, if all goes well, we're going to need to retire on our money. And so everybody is saving and investing for the sake of one day being able to pick up where their cash flow leaves off. When your human capital stops working or is no longer valued, and when your financial capital has to pick up where it left off. So let me share with you a little bit about the illusions of investing and what you can do to overcome those illusions and do better with your money. So where we're going to start is just a little bit about our general philosophy. We use this tool that gives us this wide angle view of our clients' money, and we journey them through an educational and coaching based process rather than a sales based process. You see, when we look at your money, we're seeing, if you can watch my mouse on the screen, we're looking at everything going on from a financial perspective, both in assets and liabilities, as well as the protection component in that gold bar at the top and cash flows at the bottom. Today, what we're going to talk about is just the investment and retirement component. There's all these areas in your financial life, but we're really only examining the investing illusions that occur in these two areas. So I want you to know this is going to be a very focused area around investing. Today, very focused topic. And yet that's not where we stop in our advice for our clients. So if anytime during this, you say to yourself, wow, this is really some enormous insights just around one small piece of my financial life. What else could I be missing? I would absolutely encourage you, if you're not already a client of our firm, to reach out to us, engage. You're going to have a chance before the webinar is over to engage with us. And what I want you to do is click and have a 30-minute phone call with one of our advisors. Of course, you always have the chance to go to our website. You can get the first 3 chapters of my book. You can also, via our website, request to be connected with one of our advisors. And of course, and as always, we're available right here in the Seattle area to take care of any of you. Let me tell you a little bit about my story. You see, when I got started in the business, I started out as an advisor, 18 years old, licensed, and somebody gave me a call. And they called and said, hey, Paul, I want to take you to lunch. I said, you're going to take me to lunch? He says, yeah, I work for a mutual fund company. I want to tell you what we do. I said, that sounds great. So he takes me to lunch. It wasn't a fancy lunch. It was Denny's. And as we're finishing up lunch, and he spent the entire lunch teaching me about mutual funds and investments I could put my clients in. Because of how I was raised, I reached in my pocket to pay the bill. And he said, no, I pay for this. And I said, really? He said, yeah, I pay for the lunch, because then what we're going to be able to do is I'm going to take you to lunch over time, teach you more about investments, allow you to do more work with your clients. You just love you to send that business to us. And that sounded like a great idea to me. So I went from lunch at Denny's to lunch at PF Chang's to dinner at PF Chang's to dinners at Ruth Chris Steakhouse to ultimately due diligence trips taking me to wonderful locations in Southern California, all for the sake of learning about investments in mutual funds. And what I'm going to teach all of you tonight is all the stuff that they never taught me, all the stuff that you don't see in the magazines. And it's because where it comes from is academia and those people that don't have a dog in the fight in where you invest your money, but rather the people that are studying these trends and studying what the real impact of individual investors are in the market, so that we can peel back some of those illusions for all of you. So you're going to watch me with our technology dance a little bit between sharing my screen and showing you me and talking to you. So you'll forgive me as we have these small transitions in between. So here's the illusions we're going to talk about today. We're going to first touch on the common investing illusions. We're going to talk about the independent scholarship of investing and what you can do about it. Now, what is an illusion? It's something that deceives by producing false or a misleading impression of reality. The common investing illusions we're going to talk about tonight are stock picking, the idea that we can pick stocks and outperform the market. 2 is that we can pick somebody's track record. We just got to find, if we can't pick the stock, then maybe somebody else can, and we're going to pick them based upon their track record. That we can do market timing, that what we can just move our money in and out of the market, or someone else knows enough that they're going to be able to move our money in and out of the market to produce gains for us. The real cost of investing, how much does it cost for us to really invest in those mutual funds and the investments that are handed to us every day by the financial community? And I think one of the most sinister illusions we have is that it's okay to just let them handle our money. We're going to hit each of these individually. So let's start with stock picking. Stock picking is the idea that someone choosing stocks on a belief that it's going to do well in the future. Is that any investment advisor could add value predictably by choosing individual stocks. Okay, that's the illusion. Well, what really happens? Well, what a lot of people don't realize is the idea of survivorship bias. And I think the best way to explain survivorship bias is to talk about a guy named Abraham Wald. A lot of people don't know this man may have won World War II for us, and he did it from a little apartment in Harlem. You see, there were all these mathematicians, and they would get together and they would take all the data that the Air Force or Navy would give them during World War II, pull it together and make some assessments and send it back to the generals. Well, they were doing that because they brought back all these ships, these airships that had been shot up, and they made scattergraphs of them. And they said, oh, they've been shot in the tail, they've been shot in the wings. And they sent it all off to this set of mathematicians and said, we want to add more armor. We need to know how much less in munitions can we carry and how much less fuel. And they went to work and they were almost done with the project, getting ready to send it back to the generals. And Abraham Wald, who is working on another project altogether, came in and he said the most brilliant thing that may have won the war. It may have cost us the war had we done what was about to be recommended. He said, you're looking at the wrong parts of the aircraft and you're studying the wrong planes. And they said, what do you mean? He said, you're studying the planes that made their bombing runs and returned to be studied. All of those planes did perfectly fine in terms of landing their munitions on target. We need to study all the aircraft that didn't make it back. And so sure enough, it changed the entire strategy. And it's this idea of survivorship bias, that what we do all too often when we're making any decision is we only study the survivors of a decision. We don't study those that were killed off during the process. What does that have to do with investments in mutual funds? Well, when you look at investments, we don't think about the fact that every mutual fund that's in existence now is not every mutual fund that's ever existed. So the first mutual fund came into existence back in 1923. And when it did, we just had the one mutual fund. It was MFS, First Bank of Boston. And now we call them MFS. And if you slide forward, what you're going to see is they added mutual funds every single year, and they never killed off a mutual fund until you get out to 1961. And in 1961, it was the first extinction level event. 33 mutual funds were wiped out. Then you go forward a little further out to the 1980s, and it's still not a big deal. There aren't that many funds that are wiped out every year. Then as you continue to go forward, you start to see that here in the 90s and the 80s, there's far more mutual funds that are being wiped out every year. And we get all the way out to 2013. In 2013, there were 30,000 total mutual funds. 2,000 were killed that year. Now, the question I ask a live audience, although we don't have quite the ability to go back and forth here, like for me to ask you questions or for you to answer, but I want you to consider something. When a mutual fund closes one of the funds that they own, do they just send you the money back? No. What do? They take that exact same money and roll it over to another fund under their management. You get a very simple letter. The letter says something to the effect of, we have, due to economies of scale and lowering of expenses, combined these two funds. And as they combine those two funds, what they discover is that people tend to leave their money with them, but they've also discovered they wipe out the rate of returns of the negative mutual fund. So by wiping out the rate of returns of the mutual fund that didn't do well, It would be like a child going to college, going to their parent and saying, hey, I did pretty well in school. I got straight A's. And the parent looks at the transcript and says, well, you only have 3 classes here. When in fact, the child was taking 6 and they just dropped the 3 they were going to fail. Well, that's the same thing that can happen with mutual funds. How big of an impact is that? Paul, doesn't look like it would be that big of a deal. Let's go back to our PowerPoint. Total number of mutual funds were open at the end of 2013 was 30,500, but the total funds established were 54,364 mutual funds. That means the mutual fund industry closed 23,000 mutual funds. And every time they closed a mutual fund, they're closing the mutual funds that don't do well, erasing the rate of return from their history, and rolling it into a mutual fund that did better. 23,000 times. In fact, the cumulative performance of the worst 200 of those funds was negative 79.58%. That's a significant amount of wealth erased, and then getting the opportunity to just dust the dirt off the plate and no longer have it be a part of the analyses. So what if we did put it back in the analyses? This is research from the Center for Research of Securities Pricing and Analysis out of the University of Chicago. And what they did is they analyzed every mutual fund going back to 1972. And in doing that, they allowed people to keep money invested in the mutual funds that were killed and rolled over to the new mutual fund, but they did not erase the negative results of the mutual funds that tried to do the stock picking, that tried to outperform the market. They left those rates of returns in, at least historically, and then allowed all the mutual funds to perform going forward. The top 2 lines are referencing the S&P 500 and an index that's built by the University of Chicago called the CRSP Index. The amount of money lost trying to invest with the advisors that could do the stock picking who are managing the mutual funds was $2.3 million on average. When you average in and you correct for the survivorship bias. Now, the real problem with this is that's frankly more money than most families are going to have to retire on. And that's the amount of wealth that's lost if you just started with $100,000 back in 1972. Now, right now, what most people would say to me and do in live events is, Paul, but I'm not going to pick an average mutual fund manager. I'm going to pick a great one. To which I ask, how are you going to pick the great one? They said, that's easy. I'm just going to look at their track record. I'm going to see how they've been doing. I'm only going to pick the ones that have been doing well. And that's going to allow me to get an investment that's going to outperform the market. And if you have a scientific mind, you'd have to ask yourself, is that real? The illusion is that we can find funds that did well in the past, and that is going to be a reliable method of indicating which funds will do well in the future. Well, do the winners keep winning? In another study, what they did is they took a set of mutual funds from 2007 to the end of 2009, a 3-year period. Now, the winners, highlighted in blue, are those mutual funds that beat the index they're being compared to. So if they beat the index they're being compared to, they're in the blue, that's 38%. The gray are it sounds mean, but we'll just call them losers. They're the ones that didn't perform as well as the index they're being compared to. Now, I'll say it my way, 38% did their job, because that's why we hired an asset manager anyway, was to beat the index. We wouldn't have hired them to underperform it. So 38% did their job. Literally, if we just took that 38%, which is 1,100 mutual funds, and then studied only them over the following 4 years, we'd find that only 25% outperformed the index or outperformed the market, meaning most of the managers of equity-based mutual funds did not outperform the market. Well, Paul, it's probably because it was too short of a period of time. So I think that's worth taking a look at. So if we did 2005 to 2009, a 5-year period, 28% beat the market. Only 833 are now left in our set. And when we study that set, 26% beat the market. So we went to a 5-year period, only 1% increase. And what's worse is we don't know who is going to be in the 26%. Lastly, even if you take a 10-year period, 25% beat the market. And if you took those now, what we might call top performers for the following 4 years, only 28% beat the market. And we don't know who they are. Meaning if we invested for a 14-year period of time, only about 1 in 8 of our mutual funds would actually outperform the market. And the interesting thing is that's the stock-based mutual funds. These are the bond-based mutual funds, and they don't do any better. So what are the odds? Well, if we're in a live setting right about now, I'd ask everybody to look in the middle of the table and grab a quarter. We leave a stack of quarters at each table, and we have everybody stand up and flip coins. Because every asset manager has about a 50% shot at beating the market. And we'll just play a game. We're going to pretend that I am a mutual fund owner. I own a mutual fund company, and everybody working for me now manages a small amount of money in the mutual fund, call it $10 million each. And we begin flipping the coins. Every time somebody gets head, they remain standing, and they get to take under management all the money, the quarter, of those asset managers that didn't flip heads. As we go through the room, people flip heads multiple times in a row just by pure statistical odds of having 50 people in a room. Now, by the time they flip heads 3 times in a row, there's a lot of people sitting down. And those people have a lot more money under management. And I, owning the mutual fund company, even though I gave everybody a fully functioning mutual fund with $10 million in our fictional example, I didn't market those mutual funds yet. In fact, not only did I not market the mutual funds, I wanted to wait till they had this stellar 3-year history. And now we're going to market them. And now we market those mutual funds to everybody in the advisor and the client community, showing the stellar 3-year performance. But we just don't talk about the mutual funds we shut down. As time goes on and we flip the coin some more, we get out to 5 and 6 years. Now nearly everybody in the room is sitting down. But even though everybody in the room is sitting down, there's still a few top performers that look like rock stars. Why? Because the magazines or the financial shows that are interviewing them are not talking about all the ones that are sitting down. They're only talking about the few left standing. That's survivorship bias in action. So we just don't know who's going to be the top performer, number one, and we don't know whether or not they can perform any better in the future. Currently, there's no academic evidence to help us understand how we could predict who's going to be a top performer when it comes to asset management. And that's not being mean or bad. It's just that we have no way to know. So you've always maybe wondered now why every mutual fund prospectus or every mutual fund letter or in your 401k, it says these words, past performance is no guarantee of future results. Well, the reason why it says that is because it's true. That literally past performance of any of these asset managers is no indication of how well they're going to do in the future. So let's get to our third illusion, and that is market timing. Market timing would say that what we could do is move our money in and out of the market to time the market, because then what I'm going to do is I just won't be in the market when the market's down. Now, what's interesting is to look at this study. Now, this Dalbar has released these studies for years showing the performance of individual investors against the S&P 500 index. So if you own the S&P 500, that is a general, if you're not familiar, it's a general index that just shows the performance of the US large cap stock market largely. And that second one down, the Dalbar average, the average investor of the average equity mutual fund was 3.69. Now, why is that a problem? It's because those average investors mostly paid mutual fund managers to participate in the market, and they got barely better than inflation rates of return. How come? Well, it's because of how people move their money in and out of the market. So if from 1993 to 2013, you invested, over that 10-year period, you'd have 5,040 total trading days in the market. If you stay invested the whole time, you held strategy, you didn't freak out, you didn't worry when the market went down, you would have had an 8.66% rate of return. But if you missed 5 days, That's it. All you do is miss the 5 best days. Your rate of return is down to 6.45%. If you missed the 10 best days, your rate of return is down to 4.96. And you can just follow this graph along, but you end up below inflation if you just miss the 20 best days in the market. You see, us having our money out of the market, we don't have to miss that many really well-performing days to be in a spot where we compromise rate of return. Even over a 1993 to 2013 is a 20-year period, 5,000 trading days, and you miss 10 of the best ones, and you end up below 5%. That's a sobering number, and yet people will still feel like they can move their money in and out of the market and win. Now, why is it maybe people move their money in and out of the market so much? Now, this is a video you all can Google in your own time. Be careful Googling this one. There's this type of interview being done on nearly every news network when it comes to financial news. And what they're doing is they're trying to bring on things that are novel or unique or different or something that's going to keep somebody's eyeballs glued to the television long enough that they can run another commercial in front of us. Now, this particular interview, if you ever get a chance to watch it, she's a day trader. She's only been day trading for 3 months prior to this, and she's on a national news show talking about her strategy and the way she day trades. If that's not the perfect quintessential example of what can go wrong for all of us by getting trapped and distracted by money management strategies that may not only be unproven, but are literally only there to garner our attention and get us to move our money in and out of the market. The next video, which we had some problems with the video earlier, I'm getting reported from my control room here. So we're not going to play this video live, but I want to give you a little bit of a sense of it. This gentleman, Charles Ellis, he talks about the fact that most of the trades made in the market today are the top 50 traders. And not only are these top 50 traders doing most of the trading, but they've got the best information possible. And what they're working to do is, of course, eat anybody who's a little guy. And frankly, compared to those top 50 traders, some of those mutual fund management companies are still the little guys. And what he talks about in that short video is that for us, we can get potentially just eaten alive by those people because we're trying to outtrade people with the best information and the greatest technology. But even then, the mutual fund managers that are trying to compete with those top traders, he says this: the evidence on investment managers' success with market timing is impressive. But y'all, much like my golf game, overwhelmingly negative, right? The evidence is overwhelming that the investment managers don't do a great job. But it's not positive evidence. So illusion 4, cost of investing. You say, well, Paul, maybe the mutual funds don't do so well, but at least it's really inexpensive for me to do that. Certainly less expensive than me going out and trying to invest my own money in stocks, etc. Maybe. But I'd have all of you, when we get off the call, just Google this term, the real cost of mutual funds. It should still be like the first result you see, and it's called the real cost of owning a mutual fund from Forbes. I'm going to give you a snippet of the article here in a moment, but here's what I want to call your attention to. There aren't articles like this very often in financial magazines, Forbes, Money Magazine, etc., because most of their advertising comes from money management firms. And as a result of that huge amount of revenue coming in, they can't print articles like this all the time. So when you look at a mutual fund and the real cost of owning it, you might just think the only cost of owning the mutual fund is the expense ratio. That oftentimes is less than 1%. But on top of that, every time these mutual funds trade inside, they buy a stock, sell a stock, buy a stock, sell a stock. Every time they do that, they encounter transaction costs themselves because they've got to pay somebody to make those trades. And every time they do that, there's transactions costs involved. We're paying that out of the gains of each of those stock trades. You see, it's not they don't trade it for free. And for years, even as an investment advisor, before I discovered a ton of this academic data, I thought they were paying for all those transaction costs out of their asset management fee. No, That's just administration and paying the employees and profit for the owners and sending us our statements. All the trades themselves are taken out of the trade itself, thereby costing us more money, but it's not really disclosed. It's just drag against our rate of return over time. So then we also have something called cash drag. You see, because we're in investments that other investors are in with us, and they want to move their money in and out, or they're undisciplined in the way that they invest, they've got to keep a significant amount of money in cash to handle any and all of those redemptions. So if they've got to handle any and all of those redemptions, then guess what our problem is? That money's staying in cash. Even if we're a disciplined investor, it's dragging on us. But that means even a non-taxable account on average might have total costs of 3.17%. And if it's a non-qualified account, meaning you own it personally, it's not in a retirement plan or a Roth, that could be 4% per year. That's a lot of money if what you're hoping to get in the stock market over time is 8 or 9. That's a huge chunk of your rate of return. And it's just eroding against all of us when we invest in those mutual funds. Now, part of how me talking about the way that it comes out of your assets every time you trade is called the bid-ask spread. I always have to pull the slide up when I say that, but it's a bid-ask spread. But every time they trade a stock, there's somebody in the middle that handles those trades called the market maker that makes a little bit of money. Now, it's not 50 cents on a $49 trade, but the more the asset manager trades, the higher aggregate amount of money they end up taking out of the mutual fund to pay those trades. Now, I think of it this way. I don't know if you ever heard this joke about two country boys that were up on the farm, and they decided as they grew their tomatoes that one day one of them was going to go to community college. So he goes to community college and takes marketing classes for a few weeks and comes back to the farm, and they get ready to go to the farmer's market. And he says, "How much we selling those tomatoes for?" He says, "We're selling them for $2 each." He says, and I say we take twice as many tomatoes today. He says, "How are we going to take twice as many tomatoes? We never sold that many before." He says, "Trust me, I learned it in my marketing class." So he goes and they head down to the market and they sell them instead. They're getting ready to set out the price. Says, no. Sell them for $1.50 each. Sure enough, they sell every tomato they have. His brother says, "That is brilliant. We just sold more tomatoes than we ever have. And we did it." He said, "How do we still make money?" He said, "We made it up on volume." He says, "Great." They go back to the farm again, head back to the farmer's market the next weekend. He said, "What are we going to go do this week? What'd you learn in market class?" He said, "We're going to do it again. But now we're going to sell them for $1.25 each, and we're doubling the amount of tomatoes again." He says, "How are we going to make any money?" He says, "We're going to make it up on volume." Brother says, "Well, it worked last time. I'll trust you again." So out they go to the farmer's market. Sure enough, they sold it all. He says, "This is great. Let's do it again." So the next weekend, they load up all their tomatoes. They head back, and now they have 4 times the amount of tomatoes. And they get there to the farmer's market. And he says, "What do we do now?" He says, "We are going to sell these things for 90 cents each." He says, "How are we going to make money on that?" He says, "We're going to make it up on volume." Now, you and I know with simple math that you're not going to make up on volume paying $1 for something and only getting 90 cents. But in fact, sometimes mutual fund managers are trading in a way that they're trying to get ahead of the market. But if you look at the turnover rate, that's how often are stocks traded in a mutual fund. The higher the turnover rate, the less likely they end up in the winner category. Over 5 years, over 10 years, and over 15 years, they consistently don't outperform the market overall. But the more they trade and the higher the turnover, the less likely those asset managers are to outperform the market. But we can't make it up on volume. Because as Charles Ellis said, and to give you some background on Charles Ellis, he's an academic. He owns one of the largest consulting firms in the world that consults to financial institutions. And he asks the key question under the new rules of investing is this: how much better must the active manager be to at least recover the cost of their active management? You see, if you're triggering 4% worth of cost and the market was going to go do 10 without you, that means you have to outperform by 40% total return each year just to get to the point that you paid for the cost of somebody hiring you. That is daunting. So number 5, let them handle it. Those of you that are clients of our firm know that we have an educational and coaching based process, that what we work to do is put you in a position where you understand your decisions. But what's happening all too often is people say, no, my wife handles all the investing, or my husband handles all the investing. Or they say, we've got our friend who is at our wedding and we really trust him and he handles our investing. You see, it becomes problematic because when you give somebody else responsibility for something like this and you're not clear or fully understanding the conditions of satisfaction you have, one, they did what they were supposed to do, meaning your husband or wife who's in charge of the money, they got your retirement worked out. Good. You did your job. You don't get a cookie. Thank you for getting us here. But if they don't, they didn't do what they were supposed to do. Think about the kind of weight that lives on a couple in retirement when one of them was supposed to take care of the finances and they were supposed to be able to retire and it didn't work out. You see, I think of this beautiful picture of this couple. And one of two things is going on right now. Either they are just happy and loving each other because they're retired successfully and securely, or they're running out of money because one of them, whoever it was that made the decision, was irresponsible and it was him and she's about to throw him in the water. What we need to do is understand our decisions well enough, make those decisions, and be clear about the results we want to produce for ourselves and our families with an advisor and coach that's going to help get that done. So let's review these illusions. One, stock picking. We can't do it consistently. Academic evidence shows us the mutual fund managers can't do it either. Track record investing, that we can't pick the manager based upon what they did in the past and hope that they would do that in the future. There's just not a significant correlation. Market timing, meaning can we or can some manager move us in and out of the market to help us avoid the losses? There's no evidence of that. And lastly, the cost of investing and letting others handle it. You see, we can't simply let someone else handle it, and we can't not watch the costs of our money, how it's being invested, or the results it's going to produce. So what can we do? Well, we can engage in what we call passive structured investing theory. So here's the academic story of investing and what it allows us to do when we manage money and when you engage in that sort of philosophy with your money. So there's a few components. One is we have to understand that markets work to properly price things. Two, we have to understand modern portfolio theory. Three, we have to understand what we call the four-factor model. And lastly, we need to understand that we need coaching and education when it comes to our money. So here's a bunch of folks, some in black and white, many of whom are not particularly good dressers. But I want you to notice where they all are from. Almost all of them are academics. These are not people that work for mutual fund companies. Why is that important? Because what they're after is being able to prove the truth behind the theories and understanding and analyze what's going on in the market versus trying to get us to invest money with them. And one of the core components is that markets work. There's an organization that we use for a great deal of our asset management, and they have a paper called Putting Financial Science to Work. And one of the quotes from that is, capital-based economies thrive not because markets fail, but because they succeed. So if the markets work, I want you to think of it this way. If I were to take an investment in, say, a iPhone, I invested in an iPhone, and investing in that iPhone, I bought it for $300. Well, now I want to sell it. What's it worth? What is that iPhone worth? Well, I got to put it on the internet, probably eBay, and then try and sell it and see what it sells for. I'm going to look at what other iPhones sold for. That's going to give me some idea. But I can't go list it for $10,000. The same thing happens in the stock market. You see, when a stock is priced in the stock market, it's very easy, very simple. It's priced based upon all available information. All the information in the world has come down into the price of that stock. Everybody's guesses and understandings about the future have all been priced in. So if it's all priced in, then what's the only thing that's going to change the value of that stock? Like, I'm going to buy it today hoping it goes up. Well, it's going to be some kind of new information that nobody has. Take for instance, the big earthquake that happened in Japan. Did that affect stock prices? Yes. Did anybody know the tsunami was going to hit Japan before it did? Not really. Not in a way that anybody could exploit it in the market, but it definitely affected stock prices. So all available information is already baked into every stock price. And if all available information is baked in, then how we know what it's worth is that's what it's selling for. So that's component one. Okay. Component two is modern portfolio theory. So modern portfolio theory is very simply an asset management and allocation strategy that actually won a Nobel Prize. And it was actually created at first in the late 50s and early 60s, but survived long enough to prove out its wherewithal and win a Nobel Prize for the inventor of the theory, Dr. Harry Markowitz. And here's what he said. He said that if we own two different stocks that don't move in the same direction at the same time, we can smooth our rate of return. So simply put, if you had investment A and investment B, one goes up while the other goes down, then you would end up with, instead of the red line and the tan line, you'd have this perfectly smooth blue line going up and to the right. Same rate of return ultimately as either investment A or investment B, but because they were non-correlated in their price movement, we got a better overall ride and a lesser volatility in the experience. So we could better hold our strategy. And he created this thing called the efficient frontier, that for us to be efficient with our asset allocation, we have to land somewhere on the efficient frontier. And what I got to tell you, if you have your investments reviewed by one of our advisors, most of the time, and by most of the time, I mean like 90+% of the time, when we meet people, they're not on the efficient frontier. For instance, the S&P 500 is not on the efficient frontier. And if any of you are new to asset management or allocation, let me explain what this graph is. On the bottom is the 1-year standard deviation. Think of that as risk units or volatility. And on the vertical axis is the expected rate of return over time. So the S&P 500 is taking over 18 on the standard deviation, risk or volatility scale, and yet is only producing over time about a 10.5% or 10.25% rate of return. That means all this extra risk between a moderate portfolio and the S&P 500 is uncompensated risk. We're taking risk that we weren't compensated for. And so what's going to make up our portfolio performance? Well, market timing, a little tiny bit. Other factors haven't been yet identified by science, about 2%. 4.6% is stock selection, and 91% is asset allocation, choosing a proper asset allocation strategy and holding that strategy. So choosing the modern portfolio theory strategy, holding that strategy over extended periods of time. So what do we do that's going to increase returns and reduce volatility? I'm going to give you a very, very small example of a little portfolio we're going to invent. We're going to start with just the S&P 500. Annual rate of return of 10.4% over this horizon of time, 1970 to 2013, and 16% standard deviation. If what we did is integrated in 30% of a European index, suddenly our rate of return goes up slightly and our risk level goes down because those markets don't move in the same direction at the same time. Lastly, if we added 10% of international small cap, now this is not a fully diverse or allocated portfolio, but it gives you an example of reducing risk and increasing return. If we added a small cap international fund, now we're getting 11% rate of return and less risk. So let's talk about the 4 factors. So if we know we can't market time, we can't stock pick, what does academically over time prove out that we can get better rate of returns? The market, I'm going to talk about that, how big the companies are, the value factor, and the profitability factor. So not every risk is equal. We just talked about this, that you can take risk that doesn't produce good return. Like I could take my driver and hit a golf ball and hope that it goes further than if I hit it with one of my irons. I'm taking risk. I'm hoping for a positive return. But if I took that same driver and held it up over my head during a lightning storm, I'm taking way more risk, but it's not necessarily going to be correlated with a positive outcome. It's the same thing with our investing. We need to make sure we're only taking risks that have the likelihood of being correlated with a positive outcome. So the market factor. Equities are riskier than fixed income, but equities, stocks, historically provided higher rate of return. And you can see here, total return a little over 10, but far more risk, 20% standard deviation versus treasury bills. Very little return, very little risk. But number two is small companies. Small companies historically have outperformed large companies. That kind of makes sense. A client of mine said, that makes sense to me because a small company could become a really impressive, big unicorn in the market one day. So it makes sense to me that small cap companies would do better than large cap companies on average over time. But you can see they're also more risky. 20 of those risk units is standard deviation versus 30. So it's much more volatile, goes up and down much more. Third is the value factor. This surprises many people. These are the companies where their book to market ratios are much better, meaning the stuff they own and the value of the stuff they own is a better ratio against their market cap than a company that's a growth company that may be overpriced in its market capitalization. So there's much more return there, nearly 2%, but there's also more risk. And fourth, and the one that shouldn't be surprising, but it is amazing how people invest, is that profitable companies tend to outperform non-profitable or less profitable companies if you just took the large cap US stocks against selecting out the large cap US stocks that have better profitability. So number 4 on our components at Sound Financial Group is the coaching and education. The easy reason why we need coaching and education is this, is that if you spent 2 hours every year planning for retirement with a professional of some kind every year from age 25 to 65, you will have spent 80 hours. But if you and your spouse lived to mortality from age 65 to 95, you're going to be living on that money for 262,000 hours. Now, sometimes 80 to 262,000 doesn't look that big. The blue is time in retirement, and that little tiny red sliver is time spent planning for retirement. It's just not enough in the product out. So we got to have coaching and education, not just products. To put it in another domain, people get all the time is that we want to be able to bring this to you so that you can get the coaching and education wherever you are and wherever we are. It might be during the day at your work. It might be you coming to our office, meeting with us, it might be one of our live events or one of our web events. Or this might be, now many people think this is you as a client sitting in your pajamas, being in a meeting with us, but it might also be us in our pajamas meeting with you, just to be clear. Always wonder when your advisor with Sound Financial Group doesn't turn on the camera. I should make sure the camera's on when I do that so that you know I'm smiling. That's a joke. But if you look, what's going to get you better results? If you have a great room of exercise equipment, or if you get one of the best trainers out there. This is one of the trainers from The Biggest Loser, and almost inevitably, having a trainer with a medicine ball is going to outperform you having a basement full of the best equipment ever. And it's no different with money. It's no different with golf. You know what's going to get you better results, better clubs, or a coach that helps you get a better swing. So what we want to be able to do is take care of all 4 of those components, and that's where our passive structured investing model comes in. So how do we build and hold strategy? Well, in the last few minutes here, I'm going to give you a sense of how we can build something. One, we got to stay the course. We talked about this earlier, that Dalbar study, is that your average individual investor in stocks only got 4.25%. And your average fixed income investor, meaning bonds that they invested in, only got 0.98% rate of return. That's a huge, what we would call a behavior gap, because people don't build strategy and hold strategy. They break strategy, they chase returns, they try to do stock picking, they try to time the market. So here's what we might suggest somebody do to build a portfolio. This is not the exact portfolios we build, but this will give you an idea of how a portfolio can take less risk and more return over time. And then you can work one-on-one with your advisor to build a portfolio for you that fits the objectives for you and your family. So portfolio one would be just the S&P 500. So we take 100% invest in the S&P 500, 10.4% rate of return, 16.9 in standard deviation. Okay, that's just the S&P 500. Portfolio two is 9.3% rate of return, but look what we added. If you look at the bottom, we added 5-year government portfolio, meaning 5-year bonds, and 1-year bonds. So now the portfolio has 40% bonds, 60% stocks, and yet only gave up a 1% rate of return. Most people, when they look at this, are pretty surprised that somehow the rate of return didn't get drawn down even further. If we added 1 year along with our 5-year government bonds and our 1-year fixed income, that European index, now our rate of return goes up a little bit, but our standard deviation drops again. Portfolio 4, we add international small cap stocks and US small cap stocks. Now our rate of return is up to 10.5, better than the S&P 500 with a fraction of the volatility. And last but not least would be if we built a portfolio getting nearly 11% rate of return over this horizon of time and a standard deviation of 11.07. Now, we had one great question roll in here that I want to speak to. And sometimes the question is, why is it some of these are not going all the way up to current? Why are these not going up all the way to 2015? And it's twofold. We originally built this conversation at the beginning of last year, and many of the studies that were done at that time that we have all the academic evidence behind this all closed up at the end of 2013. And we wanted to keep all that statistical data relevant. But here's the other thing that I would have you take in is that when you're looking at this 20 plus year horizon of time, it doesn't matter as much what slice of time we're taking, because what we want to make sure we're capturing in any of these conversations is how many bull markets did we have? How many down markets did we have? Right? How many of those bear markets? Because in reality, it's not the volatility of the market that's the problem. I want to say that again. The volatility of the market is not the problem. The problem is, for people, most people, is the downside volatility. You see, it's when the market goes down that people have a problem, when they weren't prepared for it to go down. But if you look at these kinds of rates of return, think about this for a moment. Here we've got these sample portfolios. This is all indexed. By the way, these are rates of returns with allocation and no active asset management. No active asset management in any of these, just rebalancing every single year. So let me ask this. If we can get a 10.9% rate of return, then why do people not put all their money there over time? And the reason people don't put all their money there all the time is because they're worried about the volatility. They're concerned about the ups and downs of the market. They're worried about it, the 2008. And it's the volatility itself that produces the reward for those of us that take an appropriate amount of money. This isn't everything, but it's based upon your planning with your advisor, the appropriate amount of money, and put it to work in the market. And if we can tolerate the volatility, then we can reap the rewards of that return. Because if there was no volatility and zero risk, then all it would pay is the same as US Treasuries or the CD at your bank, which you can reference anytime you go in to make a deposit or go on their website. And that's not very high. So what we want to make sure we do is build the overall strategy and the overall plan in the way that we work with our clients to make sure that you're in a place that the way your entire living balance sheet is oriented, your entire financial life is oriented, is that you can be okay with the equity part of your portfolio going up and down so you can reap the greatest returns. Because oftentimes what creates the negative impact to somebody's financial life is the behavior gap or the breaking strategy unintentionally or at the wrong time, which is why we do events like this one, make sure we're continuing to educate our clients so that they don't get distracted by the television, so that they don't get distracted by all of the advertising or somebody on TV that rolls up their sleeves and presses buttons with funny sounds telling you which stocks to buy. That's not who we are, and it's not what works for clients. So here's what I would suggest for everybody. I'm just going to put something up on the screen. You're more than welcome to click on it. We would love to have you in our firm or as a part of our family. Or if you're with an advisor with us now and you haven't sat down with them in a while, you should really consider doing so. Because what we want to be able to do is walk you through our planning process. Our planning process is us engaging you over a series of phone calls and go-to meetings, making sure that we can put you in the place where you can have the greatest potential outcomes financially by taking you through a coaching process, not just a, hey, we're going to meet with you. We're going to ask you a bunch of questions, write it down on a yellow pad. And we're going to journey you through a coaching process to put you in the best potential outcome in helping you make the best financial decisions you can for yourself. And we're going to do that while making analysis from an academic perspective of your portfolio, making an analysis of things as simple as your car insurance, things that could undermine and wipe you out. If you look at that little button over there, that little button is, a sample balance sheet of somebody's, where that could be your financial life, all on one screen, all on one page with a coach wrapping their arm around you. Now, if you click on there, it's just going to take you to the contact page of our website. All you got to do is just type your first and last name in there. We probably have your contact information anyway. And we will make sure that your advisor who invited you to our webinar tonight reaches out to you. And I want you to watch for these, because if we go back to how little time most people spend planning their finances, it's not enough. Certainly not enough to produce the outcomes that people would say they want about the future. That one day our cash flow, whether because of an unforeseen event or because of the ever too foreseen that we want to retire one day, that cash flow is going to change. And I know our advisors can help you explore the options of how you can address that so that you can build wealth and really do what we would call designing and building a good life. Because what that would give you the ability to do is have that good life for the rest of your life against the greatest amount of circumstances. I'm glad you all could join us tonight. Look forward to seeing you on our future webinars. And don't hesitate to reach out to us. You can catch us on LinkedIn, your advisor on LinkedIn. You can catch us on Facebook. We have a Twitter account now, as well as just go to our website. You can, if you just simply right now in the chat window, write in, I want a copy of your book. I'll also make you sure you get a copy of my book. We'll get it in the mail to you. Sound Financial Advice. And hope you all have a great rest of your evening. Take care. Bye-bye.